don't wait for Monday. In fact, this Monday is Martin Luther King Day. So if you're going to wait for regular trading to resume, you're waiting for Tuesday. Don't wait. I think we're going to have another huge move up on Sunday night, Monday, Tuesday. So to beat the herd or the crowd, I recommend that as soon as you are finished listening to this market wrap, you go right to Schiff Gold and buy more gold and silver.
The upcoming Martin Luther King Day holiday presents a critical timing risk for precious metals investors, as regular trading halts until Tuesday, while global futures markets remain active. Waiting for the standard market reopen could mean missing a significant price reset, as volatility is expected to spike during the holiday liquidity gap. Peter Schiff, Chief Economist and Global Strategist, urges immediate action to beat the herd before the trading week fully resumes. He predicts a massive upward move starting as early as Sunday night, warning that the momentum will likely accelerate through Monday and into Tuesday's open. Schiff advises that the smartest trade is to bypass the holiday delay and secure physical gold and silver immediately, ensuring entry before the crowd chases the price higher when the U.S. markets officially reactivate. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Silver's been a lot more volatile than gold all week. But the important point is that the volatility is taking place at these very high prices. And this is just another consolidation of this big breakout. So if you're thinking about looking for a big pullback to buy silver, think again. The opportunity to buy $50 silver is long gone. Right? And you're lucky if you could buy $70 silver, but I wouldn't even wait for that because I think the supplies of silver are going to start to run low and the premiums are going to really start to blow out, so that even if silver goes down, the price of silver coins and bars may still go up. And in fact, most of the move on the week this week happened on Monday. Right? So you caught the whole thing just buying over the weekend, which is what I urged all the listeners or viewers to the market wrap to do when I recorded a week ago. And I'm going to give out the same advice now. And that is, don't wait for Monday. In fact, this Monday is Martin Luther King Day. So if you're going to wait for regular trading to resume, you're waiting for Tuesday. Don't wait. I think we're going to have another huge move up on Sunday night, Monday, Tuesday. So to beat the herd or the crowd, I recommend that as soon as you are finished listening to this market wrap, you go right to Schiff Gold and buy more gold and silver. We are headed for a real crash. Inflation is going to rear its head in a way that few people understand. Obviously, the gold and silver market, when Wall Street is focusing on these backward-looking CPI numbers, they're ignoring the forward-looking action in gold and silver. And again, it makes me laugh when I watch, Wall Street, trying to figure out why gold and silver prices are going up. And their explanations are almost as funny because they don't get it. Because if they understood why gold was going up, it destroys their entire thesis. That's the basis of their recommendation of the overall stock market and the U.S. economy is great. It's not great. If the U.S. economy was so great, gold would not be $4,600 an ounce, right? Silver would not be $90 an ounce if we had a strong economy, right? We wouldn't be running these massive deficits if we had a strong economy. People were making a big deal about the trade deficit, finally took a big drop, and they want to credit Donald Trump for this big drop in the trade deficit and say, hey, maybe it's the tariffs. It's not. The main reason that the trade deficit went down last month is because a boom in gold exports. We exported a lot of gold, right? We didn't manufacture that, right? That's our gold that got exported, and that's 90% of the improvement in the trade deficit for the month was all the gold that left the country. That's not a good sign. Our imports were down, but our exports weren't really up that much. And the main reason our imports were down is because they're more expensive. So we can't afford to buy them. If you own gold and silver, if that's the money you save, then everything is going to be cheaper. The price of everything that you need to buy will be less expensive if you have gold and silver to pay for it. I mean, that's one of the reasons that I'm setting up T-Gold, because I want to enable people to have a currency, have money that will buy more over time, not less, right? You don't want your savings to erode in value before you have a chance to spend it. You'd like your savings to grow in value so that when you go to buy something, you could actually buy more than when you set the money aside. That's how money is supposed to work. The longer you wait to spend it, the more you're supposed to get, right? That's capitalism. That's how it works. It's socialism. It's central banking that has perverted sound money and given us constant inflation. But anyway, I want to leave you with these words again for the long holiday weekend. Don't wait for Tuesday. Just go out and buy some more gold, some more silver as soon as you finish listening to this weekly market wrap.
Silver's volatility is consolidating at historic highs, signaling that the window for sub-$70 metal is rapidly closing as physical shortages threaten to blow out premiums. With the Martin Luther King Day holiday pausing U.S. markets, a violent upward repricing is anticipated across global exchanges starting Sunday night. This creates a critical urgency to acquire positions before the herd reacts to the price action when regular trading resumes on Tuesday. Wall Street remains blind to the grim reality signaled by $4,600 gold and $90 silver, prices that fundamentally contradict the narrative of a robust economy. The recent improvement in the trade deficit is revealed as a statistical mirage driven by a massive exodus of physical gold rather than by manufacturing strength. This phenomenon underscores the rapid erosion of the dollar's purchasing power, confirming that holding tangible assets is the only defense against a system where inflation systematically destroys savings. Let's get back to the interview.
What happened over last weekend that helped fuel the weekend gold rally, and that was the announcement from Jerome Powell that he received a notice from the Justice Department that he is under criminal investigation for statements that he made to Congress about the renovation project of the Federal Reserve building in Washington. So I spoke at length about that, as well as the president's harebrained idea to cap credit card interest rates at 10%, and how this stuff, also the stuff that he's saying about Greenland. I mean, everything that Donald Trump is doing is pushing the world away from the dollar and into gold. I mean, he's not doing it intentionally, but the unintended consequence of the policies that he's pursuing are very bullish for gold and silver. Now, they're bearish for the dollar. The dollar hasn't cracked yet. The Treasury bond market hasn't cracked yet. That is coming, right? Gold and silver are the early warning. To me, it's just like 2007 when subprime blew up. That was the warning that the rest of the mortgage market and the financial system was going to follow. I knew the financial crisis I had been forecasting for years was a lot closer to a reality once I saw what happened to subprime. But the reason that Wall Street was oblivious, the reason that Ben Bernanke said subprime is contained, is because he didn't understand the problem in the economy, in the housing market, in the mortgage market. So from their perspective, it was no big deal what happened to subprime. I knew it was the tip of a huge iceberg. And I appreciated the warning because I understood what the warning was about. Same thing is happening now, right? The financial crisis didn't come until a year later. Subprime blew up in 07. Financial crisis happened later in 08. And in fact, in early 08, people still thought everything was great, right? Even though we were already in the Great Recession. They didn't know about it yet. I knew about it, but they didn't find out until the end of the year when they revised all of the economic data going back a year and said, oh, by the way, we've been in this Great Recession for a year. Well, what happened with gold. What's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market. So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs. First it was gold, and now it's silver, and of course platinum, the whole precious metals complex is flashing that the dollar is in trouble, that the U.S. bond market is in trouble. And what Trump is doing is playing a big role in that. But we also have some news that came out this week that I didn't have on Monday when I did my main podcast. So I want to get into this news that is also bullish for gold, and that is inflation and the inflation numbers. So we got the official CPI numbers came out on Tuesday, and the media initially hyped this up as if it was good news. Like, oh, see, inflation is going away, right? But here are the actual numbers. So the PPI, and these are December numbers. So the month increase in consumer prices was 0.3. The prior month was 0.2. So it got worse. And if you annualize 0.3, you're looking like 4% inflation. That's double the Fed's 2% target. The Fed is cutting rates. They're talking about rate cuts, and inflation is twice what they claim they want it to be. They should be hiking rates, not cutting rates. And how is this good? Then the year-over-year increase in the CPI, which was forecast to be 2.6, came out at 2.7. So it's worse. It's worse than they thought, right? Yet they're still talking about rate cuts. Right? Now, I guess where they got the improvement, right? And this is, talk about making a lemonade out of lemons. But the consensus for the core month-over-month gain was 0.3. And instead, we rose by 0.2. That's what Wall Street was celebrating. That's nothing. I mean, it was 0.2 the prior month, so no improvement, right? And year over year, they were looking for 2.7. Again, this is the core, not the headline. They were looking for 2.7, and we got 2.6, which was the same as we got the month before. But so what? It was 0.1 lower. It's meaningless, right? And remember, the Fed wants this to be 2%. We're not even close to 2%. But what was worse than the CPI was the PPI that came out the following day. Now, the PPI, I think, is more important than the CPI because it's forward-looking, right? The PPI is producer prices, and producers generally feel the pinch of inflation first, right? Because they're buying at the wholesale level, and they get hit with the cost increases, and then they pass them on to their customers by raising their prices. So you would expect that if price increases are coming, that they will show up first at the producer level and then at the consumer level, right? That is the order. So the producer price is more forward-looking. Now, if you look at the producer prices for the month, okay, the overall number was a little bit better than expected at 0.2. But the year-over-year increase in producer prices jumped from 2.7 to 3%. 3% year-over-year rise in producer prices. Much hotter than the 2.7, 0.3 hotter than they thought. Now, the core this time came out in line. They were looking for up 0.2, and we got up 0.2. But that was double the 0.1 that we got in the month before. But here's where it gets real ugly. The core, ex food and energy, year over year, core now up 3% versus 2.6% the month before. And again, for the producer prices were a month earlier. Consumer prices were December. This is November, right? And so that's even worse because we haven't even got December yet. So we're 3% year over year. Ex food and services and trade up 0.2. And here's another number. I don't know if this is the super core or what it is, but it's the producer prices, excluding food, energy, and trade services, that was up 3.5%. And the Fed is cutting rates, and they're talking about more rate cuts in the face of already high inflation going up, right? It's not like we have above target inflation and it's coming down. We have above target inflation and it's going up. Meanwhile, everybody wants to pretend, especially Donald Trump, that inflation is gone, that it's dead and buried, right? That the Fed is just being stubborn and not cutting rates in the face of, vanquished inflation. The reality is inflation was never really dead, and now it's coming back stronger than ever, and the Fed is behind the curve. The Fed should be hiking, and instead it's planning the next cut. This is extremely bearish for the dollar. The dollar is going to roll over. This is very bearish for the bond market.
The current surge in precious metals is serving as a critical early warning of a pending sovereign debt crisis, mirroring how the subprime collapse of 2007 foreshadowed the broader 2008 financial meltdown. While the previous crisis was driven by private mortgage credit, the analysis posits that the subsequent systemic failure will center on U.S. Treasury debt and the dollar itself. This outlook is reinforced by alarming inflation data, with forward-looking producer prices, specifically the supercore metric, jumping to 3.5%, signaling that price pressures are accelerating rather than cooling. Despite this reality, the Federal Reserve remains committed to rate cuts, a policy error that suggests they are dangerously behind the curve. By ignoring the rising inflation, central planners are effectively setting the stage for a bond market collapse and a significant devaluation of the dollar, leaving gold as the only reliable hedge against government insolvency. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.